All right, welcome everybody to Financial Statements. Our very own Boston business mentor, Ramesh Advani, is going to be speaking to you on this very important topic. Although it can be sometimes overwhelming, I think Ramesh does a really nice job at laying things out in a nice, neat package so that it's understandable. So, I just want to introduce you to Boston Business Mentors. If you aren't familiar with us yet, our goal is definitely small business education and mentoring. And we're going to do that in many different ways. And we've got some exciting new programs coming up in 2026 that we can't wait to introduce to you. But at this time, you're going to find information on our website. We're definitely always updating that resources page. We have one more workshop this week, and then we'll be taking a break for the holiday season, and we'll be back in January. So definitely watch for that full complement of January presentations. And without a doubt, mentoring is definitely the most important thing. Our volunteers have different experiences and skill sets, and they want to help you. They want you to be successful. We're working with folks at every stage, whether you're at the very beginning or ready to leave your business. We have mentors that can assist you, and there is no doubt that studies show those businesses with a mentor are more successful. We can be the sounding board for you. We can help you find resources. We can help you with direction and information. So we're really excited that we can offer these things to you. So let's get started with today's presentation. And I'm going to go ahead and turn it over to Ramesh and let him explain everything.
Thank you, Teresa. And hi, everybody. Good afternoon. This workshop is kind of has a lot of slides, like about 25, 26 slides. So I'm going to try to go as slow as possible. I am not going to assume anything that you know about financial reports, but the bulk of the understanding that I want to make sure I pass on to everybody is comes towards the end of the workshop session where I will show you little things you can do by looking into your financial reports and show you how you can do that and what triggers you should look for, etc. So uh, I apologize. I hope I'm not going to go too fast for anybody who wants to understand this, but I will pause in between at some couple of points of time, and if there are questions, if you just put your questions in the chat and I'll check with Teresa, and I'll try to answer those questions. All right. So, having said that, I just want to make sure everybody understands why we're doing this workshop, because if you are a business owner, you need to understand financial terms and concepts in basic English, not using words that only accountants and tax accountants and bookkeepers understand. Um, and if you understand your financial statements without having to constantly go to somebody else, it'll help you make good financial decisions for your business. So, those are the two objectives I'm hoping I accomplish with you as we go through this. So, what you see here is what I am going to cover. I'm going to first do a little diversion and talk about bookkeeping, and then get into the financial statements. So you can see those numbers that you see there. That's the bookkeeping slide is number 6, the financial statement overview. And from there, we go into 3 different financial statements: the income statement, the balance sheet, and the cash flow statement. Cash flow statements can become confusing, so there are a few more slides with the cash flow statements. And then in slide 22, I show you how do you get behind your numbers, because it's important to not just look at the statements, but then to understand what are these numbers telling you. Okay, so if you can bear with me, I'll start off with bookkeeping. And but even before that, as I said, financial statements contain a lot of information, and when you have these financial statements and your bookkeeping set up, you will understand how your business is doing. The bookkeeping system, which your bookkeeper or your accountant keeps for you, it keeps track of all financial transactions. And in addition to looking at the bookkeeping system, there may be other operational information that you need to possibly capture to help aid your decision making as your business grows. So, not just looking at numbers, there might be some operational information. Well, I'll get into some examples when we go through this. So, what goes into your bookkeeping system when I say all transactions? All your sales transactions, which cover all the products you ship or the services you deliver, which drives your revenues. Then when it comes to purchases, which go into your costs, all the raw materials, supplies, equipment, all the bookkeeping records have all that information. In addition to the purchases that you make that go into your product, you also have expenses for your business, payroll, utilities, insurance, your uh, real estate lease payments. And finally, if you have loans or loan payments, there are financial transactions as you get the loans and as you pay them back. All of that information is kept on your financial books. This may sound obvious because if you're running a business, you know that that's what your bookkeeper will ask you for information so he or she can enter that into your bookkeeping system. What kinds of bookkeeping systems exist? It's important to know that these days you don't have to do everything by hand, you don't have to do anything by hand. You use software. The most common one is QuickBooks. If your system is simple, or your business is simple, you can also use Excel. But we recommend you should use a software system like QuickBooks. And you should make sure that when your bookkeeping system is set up, it is set up carefully so that when the financial statements are produced from there, uh, it gives you information that is useful. This may sound like a no-brainer, but your main job is to serve your customers and provide the products or services. Your job is not to be the bean counter. So you should make sure that you use an accountant who will make sure your bookkeeping system has been set up correctly from the start. Now, there are many people who get into business and they say, okay, I can do this myself. I know how to use software. And they go in and set up the system for their business themselves. And many times they are not set up correctly. So if you are in any kind of situation like that this year, you just started a business, I would say before you start your new fiscal year 2026, make sure you get an accountant to help you recategorize or reset up portions of your business. It's very important to think carefully what is the information that you will need so you can analyze your business and run your business before you go to that accountant. So those are just a couple of overall comments. I'm going to show you an example of the setup for a bookkeeping business. And the example I'm using is a photography business. A business that offers different types of services may have a need to track information separately and differently associated with each of those services. So, for example, in this photography business, this small business does portraits. It could also be a one-man business. This person does portraits, goes and does photography and family celebrations, and also does business events. One column here shows you what is the financial information. And in addition, in order to understand the business, the owner also needs to make sure they are capturing some non-financial information. So, without going into the details of what is the financial information, you will notice portraits and family celebrations at business events, all of them have one particular financial information which is needed for all of them. What are the fees that are being paid? However, when it comes to discounts, they might give discounts for portraits. They may not be giving discounts for family celebrations or business events. Business events, they might have travel expenses, and the business that they are providing the service to may be open to paying them the travel expenses. So, travel expenses are a separate type of financial information. The family celebrations, there might be printing costs, but also album costs. The non-financial information that you see are all different for each of them. Time, the use of time, because you're getting paid for your time, and the more time you spend, you want to be able to charge more and get the revenue coming in so you can see that's one that you find in all of them. However, but there are others like the prints that are ordered, albums, or time spent in editing. You might be spending a lot of time in editing for business events, and you might have potential more follow-up business. So it's, future business you might get from that client. So as you can see, there are a lot of data points that are captured. So everything that you see in the financial information, that is all in your bookkeeping system. In addition, you probably have from your operations for whatever your business is, non-financial information. So I hope you understand how this was set up for this example. It's a simple system example, but you get what I'm saying. Any questions at this point in time?
We don't have any questions posted.
Great. So what I will do now is I will go into the financial statements. We were talking just now about your bookkeeping system, your transactions that occur through the period of time. And when I say period of time, transactions happen every day, every week, but books are kept and reported on a monthly basis. So the first column here shows you all your orders and activities, information, transactions go into your system. And then at the end of the time period, you produce from your financial system, say from QuickBooks, an income statement for that time period, a balance sheet, and cash flow. Income statements record financial impact for that month, for that period. Balance sheet captures a snapshot of your assets and liabilities at a point in time. So when you get financial statements at the end of the month, say for example, the financial statement you would get at the end of December, or for the month of December, or for the year, that will be the income statement impact, profit and loss, etc., for that month. The balance sheet will be for a point in time. So your financial system will produce a balance sheet for, say, the month of December. And the cash flow statement takes the events that took place that are reflected in your income statement and on the balance sheet, and how those changes affect what's going on. So, what we are going to go through is we're going to go through each of these financial statements one at a time, and I will talk about different elements in each of those statements. Okay, so let me start off.
Can I give a question, please?
Yes,
To clarify, is the income statement is the same as a P&L statement?
yes, correct. I will get into that a little bit more. You know, in the financial world, I think the financial people want to confuse uh, business owners. So they use many different words and jargon. So the income statement is also called a P&L statement.
Thank you.
One general concept is that these statements show different aspects of the financial state of the company. They are not independent. And not that you're going to do that, but if you had two out of these three statements, you can always construct the third one. But computers do all this for you, so you don't have to do it yourself. They can appear very complicated, but the basics are not difficult to understand. So we will start with the income statement, also called a P&L, which is a profit and loss statement. I am going to first define certain items that show up on your income statement. If you're taking part in this webinar and you have your own income statement with you, that will be great, but don't worry about it. I will show you an example of how this looks. So for each item, I'm going to tell you the definition of that item and also what are some other names that are used for those items. So the very first one on an income statement, the number you see is sales. It's also called revenue, and also in general jargon, it's also called top line. After the sales line, the next line is something called net sales because all the money that a client might pay does not really reflect the net sales coming to you because there might be commissions that you're paying somebody else who's making the sales happen. You might be paying freight costs to someone who's delivering these goods. So those items, when they are removed from the sales numbers from the financial system, that's called net sales. The next major category is the cost of goods sold. And think about this as basically all the costs of the products or services that were sold in that period. And what these costs include the raw materials that are used to produce those goods, the direct labor that is used, and also other manufacturing costs, overhead costs. Cost of goods sold is also called cost of sales. When you subtract from this net sales, cost of goods sold, you get a number on your P&L called the gross margin. It's also called a gross profit. So those are the top items that show up. As you go further down in the income statement, you have expenses related to your operation that don't particularly apply to one particular goods. These are operating expenses. So you might be paying rent, you might be paying utilities, insurance. These are costs that cannot be directly assigned to a specific products. Other names for these operating expenses are fixed costs, selling, general and administrative costs, etc. There are other names used for that. So on your P&L, your financial system may call it SG&A, So when you subtract operating expenses from your gross margin, you get a number on your P&L called profit from operations. This is your operating income. This matters a lot to you because that is the kind of money that is coming into you from your operations. And then from those profits, another line, the information is non-operating expenses. So for example, if you have borrowed money, you're paying interest, or for example, if you have lent money to somebody and they're giving you interest, those expenses, non-operating expenses are shown over there. Um, When you subtract those from your profit from operations, you get net profit or loss. This is the net income or the bottom line. So there's the top line and the bottom line. And it is on this net profit that you pay taxes. And after you paid taxes, then you get money that comes to you as the owner or goes to your shareholders. Income statement, this is what it looks like. So, for example, over here you see the sales of 55,000, they paid commissions of 5,000, net revenue was 50,000. The cost of goods sold was 30,000, so the gross margin was 20,000. 50 minus 30 is 20,000. Then there were a bunch of operating expenses. When you subtracted that, you get this profit from operations. And from there, if you subtract interest expense and depreciation, you get the net profit. On the right-hand side, you see some numbers. This is something that you can do yourself. It doesn't come out on your P&L, but if you can express all your financials on your income statement as a percentage of sales, you will be able to compare how your income is doing in one particular period versus another period. So for example, here, your gross margin was say 40% in the month of November. And in December, when you look at the numbers, looking at the actual numbers may not be able to give you a trend. If this 40% went to 50% or went to 30%, you'll start to say, why did this happen? What's the trend? What is it shaping up? And the same thing applies to, let's say, advertising was 5%. You spend 5% this month on advertising, but next month you might spend 0%. You will know. I said, yes, we paid a bill, when we got these invoices from this vendor who does our advertising. So it's good to keep an eye on something like this. It helps you understand what's going on with your income statement. Any questions on income statement?
There's no questions.
Okay. I will go to the next statement. So this is the income statement for a period of time. Now we'll go to the balance sheet. This is a financial report, which is a snapshot of the assets and liabilities of your business at the end of a period. Okay, it's at a point in time. So when somebody says, you ask your accountant, give me a balance sheet, they'll ask you for when. Do you want this for the end of this month, end of this quarter, end of this year, whatever, So that's how you should think about a balance sheet. It's a point in time. Look at your assets and liabilities. So I will first start off explaining terms that show up on your assets. On a balance sheet, and the reason it's called a balance sheet because a balance sheet is balanced. The numbers on the left-hand side are the assets, and the numbers on the right-hand side are liabilities and one other category. We'll go into that. In the asset column, we will start from the top. The first asset that you will see is cash. So you understand what cash is. Cash is the balances that you have in your bank account for the business. The next item, which is not as fluid as cash, but it is just as good, is accounts receivable. So people buy products from you on credit, and when you send them the invoice, they've got the invoice, but till they pay you, that amount of money, what the customers owe you, is called accounts receivable. You're expecting to get this money. This is going to become, when it comes in, it'll become cash. That's accounts receivable. The next asset, which is less fluid than accounts receivable, is inventory. Inventory is value of all the materials that exist in your warehouse or on your production floor that you have not yet turned into sales. And there are many different types of inventory. What you sell is basically finished goods. So the value of the materials that you intend to turn into sales is called inventory. How the values are assigned to those items, there are many different rules. And separately, if we were going to be talking about manufacturing inventory, I would go into that with you. So below those lists of assets, the next set of assets are called net property, plant, and equipment. This represents all the assets that you have in your business, excluding the depreciation charges to date. What is depreciation? When you buy an asset, a capital, spend some money. So, for example, you are manufacturing cars and you have a robotic production line which costs millions of dollars. You want to be able to reflect that two things. One is as you keep using that asset, the asset is becoming older and is losing value, as well as the cost that you spend, say $1 million on that, you also want to reflect that in your product cost. And the way you accomplish both these things is through a term called depreciation. Depreciation is a number that you see on your income statement. And when you take that depreciation from out from the gross value of your assets, you get what's called net property, plant, and equipment. The next item is, let's say you have some patents or you have copyrights that you have made an investment in. Those that's called intellectual property right, and that is an asset. So reason we want to show that in your assets is because that's value that your company has. So if in the future you are going to sell the company or liquidate the company, this intellectual property asset will have some value. So that's what you see on the asset side. On the right-hand side, you see two categories. You see liabilities, and in your liabilities, you have accounts payable, which is just like you have accounts receivable. Accounts payable is what your suppliers owe you, and debt. So debt is a liability. This is what you owe lenders. And normally, all the debt is described under two separate lines: current debt and long term debt. Anything which is due within a year is called current liability debt, and anything long term debt is long term liability. The other thing that is there on that same right hand side on your balance sheet is something called shareholders equity. And shareholders equity has two major elements. One is capital stock, and capital stock is the original investment and any additional paid in capital that your owners, the stockholders, have bought capital. That's the shares. And then the second piece of shareholders' equity is, so when you make money in a given year, you don't necessarily take that and put it in your pocket or distribute it as dividends. You might invest it back in the company, and the portion of all the profits that are not paid out and are accumulated and put back into the business, that's called retained earnings. So that's what's on your balance sheet. And I will pause here before I get into this. Any questions on the balance sheet?
I don't have any questions submitted.
Okay, so this is what a balance sheet looks like. It's balanced. Left-hand side are the assets that add up to 100,000, and on the right-hand side are the liabilities and shareholders' equity that also add up to 100,000. And you can see these things. If these two are not exactly the same at the bottom line, somebody has given you a bad financial report by way of a balance sheet. But since the transactions are entered by your bookkeeper and the computer system calculates it, you will not find any errors in this. So, by definition, what you need to think about, what is your equity in the business? Another term used for equity is net worth. That tells you what is the net worth of your company. So in this case, the net worth of the company is 72,000, which is assets minus liabilities tells you what the net worth is. I also want to just make sure you understand another term when it comes to looking at balance sheet, something called working capital. You need to make sure you understand what is the current asset and liability and what is the long-term asset and liability. Current assets are assets that you expect to convert into cash within a year. And that is terms like cash, accounts receivable, inventory. Current liabilities are liabilities that you're expecting to pay within a year, which is accounts payable, short-term debt, and the current portion of long-term debt. The term working capital, if you take your current assets and you take your current liabilities, subtract the current liabilities from your current assets, that's working capital. Working capital is the money you need to run your business. You should make absolutely sure that your working capital stays positive at all times so that you can meet the obligations to your suppliers and lenders and keep this as a running business. I'm going to go on to the cash flow statement. The cash flow statement shows the flow of cash in and out during the period. All the items on a cash flow statement, they relate back to numbers that are in your income statement or on your balance sheet. The bottom line of the cash flow statement is the net change in cash. When you look at the bottom line, you should be able to tell whether your business was a net generator or a user of cash in that time frame. Just want to make an observation here that a business can be profitable, and many people that have companies that grow very fast may appear profitable, but quickly put themselves out of business because they require too much cash. So, staying on top of cash, if you take one thing away from this webinar, it's important to know cash is king, and what your cash flow statement looks like matters more than anything else. I'll give you this example here. Let's say you're a merchandiser and you sell shirts. You buy the shirt for $8 and you sell it for $12. Each shirt gives you a profit of $4, right? Which helps, can then go towards covering your overhead. You may have enough cash to replace the shirt, but you may not have enough cash to grow your inventory. Positive profit, but inadequate cash flow. Because if your shirts are selling well, you might say, oh, I need to buy more shirts to sell them, but you may not have enough cash available to pay the vendor from whom you're buying those shirts. So it's important to remember you have to try to be cash positive at all times. Long-term assets and short-term assets, long-term liabilities and short-term liabilities. Current assets expect you to convert into cash within a year. Current liabilities are liabilities that are paid within within the year. And so working capital is current assets and current liabilities. I thought I just covered the, sorry, I'm going backwards in time here. So cash flow statements. The cash flow statement reflects three types of cash flow: cash flow from operations, cash flow from investment activities, and cash flow from financing activities. So there's cash inflow and cash outflow. And your operations, when you sell something and you incur costs, you get net profit, and there's cash generated. You also may have liabilities that increase, and in other words, like accounts payable. So you have accounts payable, but you're not having cash go out because it's on your balance sheet as a liability. Cash flow from investment activities is if you have non-current assets like capital investments, um, you have changes on your balance sheet that take place because of that. That's the cash flow from investment activities. And financing, similar to investments, if you are borrowing money or you're getting cash coming in because somebody has bought more stock, that's cash coming into you, or you have cash going out because you're paying dividends. Those are cash flow from financing activities. So there are three types of cash flows. So now just bear with me, and I hope you can all see this. Numbers may look a little small, but what you're seeing here is an income statement over here. We went through the income statement, and you have a balance sheet, which has got the balance sheet, assets, liabilities. And on the balance sheet, for the time frame that we're looking at for the income statement, you get the balance sheet at the start of the time period and at the end of the time period. And if you look at the start and end, you record the change in those balance sheet items. So for example, we started the time frame with 18,000 in cash, we ended at 20,000, you had 2,000 more cash. Accounts receivable, you started with 18,000, you ended with 20,000. Your cash actually went down by 2,000 because you were selling it on credit and you're expecting cash. You spent the money, but your accounts receivable went up. So you have to understand how you record this. Now, what we're going to do is you're going to construct this cash flow. We're going to start off, the starting cash was 18,000. Where did I get that? I got that from here. To that cash, I added in the profit I got. Where did I get that net profit? I got that from here, from my income statement over here, 5,000. Next, depreciation. Depreciation, as I explained earlier, is you have spent money a long time ago and you're taking a portion of that cost and you're reflecting it on your income statement. But there is no cash involved with depreciation. So you're adding that back here as $1,000. The next thing from operations, you're decreasing your accounts receivable, this 2,000. Your inventory is going down, that's 1,000. Your accounts payable went up by 2,000, and your accrued payroll went up by 1,000. So you take all these pluses and minuses, and your operations generated $6,000 in cash. Then your investment activities, you had equipment that you had 28,000 at the start of the year, and at the end it was 30,000. You spent money on that business. Of course, you also had depreciation. You see the net over here. So you purchased $3,000. So your cash went down from investment activity by 3,000. And you also, your loan activity went up. You took $1,000 more in loan, your bank debt. And so your financing, your cash went down by 1,000. So even though your operations generated 6,000, you had cash use up of 4,000, your net cash flow went up then by 2,000. if you take your starting cash, add the net cash flow, your ending cash is 20,000, which you can also see on your balance sheet. What we have done very quickly here, generated, showed you how you can create a cash flow statement from your income statement and balance sheet. But don't worry, your financial system will produce a cash flow statement for you. What you need to do is be able to go in and understand, why are these numbers reflecting what they're reflecting. So I'm going to pause here and see if there are any questions.
We it's unrelated. So can we come back to it?
Yes, yes. So why is it important to manage cash flow? We've touched on this indirectly. It's a very important task for you. If your business is growing very rapidly or you're a startup, you will be struggling with cash. You need to try to do a week by week projection of your cash inflows and your cash outflows. What that means is you need to be pretty good at forecasting what is the cash that you will receive from the sales you made and what is the cash you need to spend to buy supplies and pay bills. Remember, when you're building a product, the cash outflow happens first before the sales happen and the cash inflow comes in. So you must make sure that if you're projecting in your forecast a shortfall, you must address the problem by increasing the sales or collecting accounts receivable or working with suppliers to arrange delay in payments. In addition, of course, you'll use the cash to pay your taxes, and it's important that you pay your taxes on time and in the proper amount because you don't want to have a tax lien on your property. So I'm going to spend the next few minutes talking about how do you use all these reports and understand your numbers. While lenders or investors might ask you for financial statements, you will find that they are very useful to you as long as you spend some time getting behind the numbers. Some basic tools you should know, have knowledge about the details, what went into the numbers. Another one is you should know how to do comparisons, comparing your numbers versus your plan numbers, which is a budget. People call it a budget. Comparing your results to a previous period, previous month, previous quarter, previous year, comparisons to general industry. If you're in a particular industry segment, you should be aware of what some of those metrics look like compared to the competition. And of course, you should also know what your fixed costs are and what is the sales level you need to make sure you're covering your fixed costs. And that's called a break-even point. So there are some basic tools you need to be familiar with. It's important to know what is this behind your number so that you don't misinterpret what you see. So I'll give you two or three examples. A large customer usually orders twice a year, but in December places a third order. They've never done this before. So most likely you're pre-booking next year's first half sales for that order in this year. So when you're in the next year, you have to remember, aha, this was unusual. They placed a big order in December. A lumber yard sells a lot of lumber because they need to repair following a natural disaster. So if this particular business sells a lot of lumber, it's not likely to be repeated in the future because not having this natural disaster come every time. Uh, Another good example is about 25 years ago, there was this Y2K situation where technology companies recorded record sales in 1999, but it fell off in subsequent years. And a lot of these technology companies went under because they didn't have the business, they didn't get the cash. So we'll talk about comparisons, and we kind of touched on this when I was explaining income statements. If you take 2 periods of time income statements and convert the numbers into percentages, you should be able to look at and explain how numbers have changed from one period to another. Comparing balance sheet from a previous year. So for here, there is a balance sheet, end of the year 2014, end of the year 2015. Make sure you're looking at the balance sheet for the exact same time on the calendar. And here you see over here, cash has decreased. Accounts receivables have gone up. Are you collecting slower? You built inventory. Did you mean to build inventory? It went from 27 to 30. Was this deliberate, or you just have things that are stockpiling? You made a $3,000 investment in some equipment. The net property, plant, and equipment went up only 2,000 because $1,000 of depreciation was applied. So when you're looking at the balance sheet changes, similarly, when you look at liabilities, you should be able to ask these questions. Why is this changed from this to that? I mentioned something called the break-even point. This is a concept you should understand. This is the definition of a break-even point is the amount of sales that you have to cover your fixed costs. So the easiest way to think about this is that each unit of sales makes a certain contribution to profit after you have paid for the materials and labor. The break-even point is how many units you'd have to sell for the gross margin that you get to cover your fixed costs. So I'll give you an example. Let's say you sell $50,000 worth of product and there are 5,000 units at $10 each. Just keeping it very simple. And let's say your gross margin was $4 per unit, which is $20,000, 5,000 units times 4. And let's say your fixed costs are $15,000. What are fixed costs? Fixed costs are costs that you'd have to spend on whether you sell 1 unit or 20 units or 30 units. Let me give you an example of a fixed cost. It's the rent that you're paying or the mortgage that you're paying for your property. Whether you sell anything or not, you still have to pay that monthly rent. So that's the fixed cost. In this case, the fixed costs are $15,000 and the profit from each unit is $4. So that means you have to sell at least 3,750 units to be able to pay for your fixed costs. The revenues at that point in time, remember it's $10 per thing you're selling, revenues are 37,500. At this point, once you have covered your break-even point, you will start making net profit. It's important to know your break-even point because you will not be making any money till you sold at least 3,750 units. So you understand the concept. You don't have to memorize this. When you get these slides, you will be able to look at it and look at your business. And you should know off the top of your head, what is your break-even point in a given month or in a given year? So as your business is growing, you're faced with a lot of decisions, and your financial statements will help you make good decisions. Is your business making enough money to pay you a decent salary? Can you afford to hire an employee? Buying a new piece of equipment, is that a good investment? If you were to hire a social media consultant and pay them for their advice, will it help make your business more profitable? Will you be able to sell more? Which products or services are most profitable? By knowing the gross margin for a product A versus product B, you should be able to tell which ones are more profitable. Things that are not profitable, should you cut any of those? products or services? Are they customers who are not profitable because you're giving them a lot of discounts? Maybe they're buying high volume, but at the end of the day, they're not bringing money to the bottom line. Should you be cutting them out? So there are lots of these things you can think about. I would also suggest if you need help, basically, for your business to help you analyze that, you're free to come to Boston Business Mentors. We have people with strong financial background, uh, besides myself. You can make an appointment and share that. Anything you share with Boston's Business Mentor is confidential information. And what they can help you do is ask questions. Tell you the questions you should be looking at when you look at it. So, very quickly, financial statements is a lot of information. The information gets to financial statements from your financial system through bookkeeping. The three major statements: income statement, the balance sheet, and the financial cash flow statement. So it's very important that you understand what's behind the numbers. Um, this is pretty much like the end of my webinar comments. I will open it up for questions or turn it over to Teresa, depending on how things go.
Yeah, we do have a question. Can you talk a little bit more about EBITDA? One of the from one of the previous cash flow statements and how it's calculated and why or what it means for your business.
Very good. Yes. So it's another one of these typical financial statements. It's EBITDA. It's called, many people use the word EBITDA. It's EBITDA. So it's the earnings. When you look at the earnings, earnings is profit. So when you look at your profit and loss statements, you have the earnings. And if you leave out of that depreciation, which is the D, any interest and taxes that you pay for your business, and you look at the earnings and exclude those numbers, that tells you how your company is doing from an operation standpoint. So I would tell you it's simpler to just look at your operational profit line, net profit from operations. That's the same thing as EBITDA.
Okay. I do not have any other questions submitted, but it doesn't mean you won't have a question later. So,
Yes.
so yeah, watch for the follow-up email. We'll include information from today and certainly reach out to a mentor, and then they can talk to you directly about your situation and your business specifically. So we're happy to do that for you. And I thank you, Ramesh, for your time today. And we appreciate all of our clients, and we hope to see you again on a new webinar very soon.
Thank you. Bye.
Bye.